The Chinese currency, the yuan, has just fallen to its lowest levels since 2008 relative to the US dollar. The moment Trump won the elections on November 6th, the Chinese yuan started weakening rapidly against the US dollar. Donald Trump is now officially the new US president of the United States, and investors are positioning for a potential trade war between the US and China. Trump has already announced that he plans to bring an additional 10% tariff on Chinese goods, which would make them less competitive overnight. After decades of companies exporting their production to China, Trump is now attempting to bring back business operations to the United States through the use of tariffs. This trade war is coming at the worst possible moment for China. For the past 3 years, the Chinese economy has been suffering from consistent weakness. We can see that simply by looking at the Chinese stock market that is still down about 55% from its all-time high in 2021. 40% of China's economy comes from manufacturing. As China has become the house of production for the rest of the world, Trump's tariffs could put a dent directly in one of China's most important sectors at a time when domestic troubles are already brewing within the Chinese economy. The Chinese Credit Impulse Index, which is considered to be a key indicator for China's economic health, is hovering at some of the lowest levels since the global financial crisis. Consumer confidence in China is still sitting at the lowest levels of the last 30 years, and Chinese property prices have been consistently declining for the past 3 years, suffering their largest drawdown in over 20 years. So the US-China trade war is really the cherry on top. Many investors speculate that this will push the Chinese economy over the edge, potentially into a much more severe financial crisis. But not all hope is lost for China. The Chinese government has been opening up the printing presses as a tool to stimulate the economy. Chinese authorities have now started considering fiscal policy tools, which basically means direct government spending. While monetary policy makes borrowing cheaper, fiscal policy injects money straight into the economy through infrastructure projects, subsidies, and other forms of direct spending. So it directly boosts activity in critical areas of the economy. This is an important development because fiscal policy has the potential to directly address the underlying issues, such as low consumer spending and weak housing demand. Recent announcements from China's policymakers introduced a $1.4 trillion stimulus to boost consumption and stabilize the housing market. While this did initially spark a rally in Chinese stocks, which rose by 50% following the announcement, they have now almost entirely reversed these gains. This begs to ask the question whether Chinese authorities are even capable of reversing the downwards trend in the Chinese economy. To answer that question, we have to look at what is happening underneath the surface of all of this price behavior. Something happened right here following the announcement from authorities that could be suggesting the Chinese economy has indeed witnessed a significant turning point. We can see this big pivot by looking at the indicator called the Shanghai Composite Breadth. This indicator tracks the percentage of stocks in the Shanghai index that are trading above their 200-day moving average. So basically telling us what percentage of Chinese stocks are trending up. After the announcement of the fiscal measures, this breadth indicator surged to 90%, indicating that over 90% of the stocks on the Shanghai index were trending higher. It has since cooled off a little, but this level of participation across stocks is not quite common. Historically, such a surge has often been marked by bottoms in Chinese equity markets, and hence the Chinese economy. For example, the last 4 instances of similar breadth spikes, like in 2006, 2009, 2014, and 2019, they all preceded sustained recoveries or consolidation phases, where the market didn't revisit its prior lows. When there is this kind of extreme level of optimism, it suggests that financial markets believe something has shifted in the macro picture. In other words, this could be telling us that the financial markets believe the fiscal stimulus announcement from Chinese authorities really does have the potential to reverse the course of the Chinese economy. Of course, this doesn't guarantee a massive bull run for Chinese equities. For example, after the breadth spikes in 2010 and 2019, the Chinese market entered long consolidation periods rather than explosive rallies. But the key takeaway is that these events have historically often occurred at the end of downward bearish phases. Even a stabilization at these levels could potentially provide a strong foundation for future growth if supported by improving fundamentals. Another positive sign is that Chinese companies have increased their profitability substantially over the last year, climbing from 4.5% to 5.3%. Companies are cutting costs, streamlining processes, and finding ways to remain competitive despite the broader slowdown. This trend reflects the resilience of many Chinese businesses, even as external conditions remain difficult. But profitability alone is unlikely to drive long-term growth. What's missing is revenue generation. Chinese stock market revenues have been declining significantly since 2015 and continue to do so even now. The difficult economic conditions in China have been driving this decline. This is where fiscal policy could potentially make a difference. If the Chinese government succeeds in boosting domestic demand, stabilizing housing, and encouraging investment, it could see a much-needed turnaround in revenue growth. The big counterargument to all of this, of course, is that the US-China trade war could completely offset the Chinese stimulus measures, as falling exports to the US will be an additional downwards force on these revenues over the next 4 years. From a technical perspective, the Chinese stock market ETF called MCHI is trending higher. Price has been printing higher highs and higher lows since 2024. If we put on the 100, 150, and 200-day moving averages, you can see that they are sloping up, indicating upward momentum. This aligns with the historical patterns we discussed earlier, where breadth spikes often marked significant turning points. But let's be clear, this is not without risks. If the government's fiscal efforts fall short, or if external pressures like the US-China trade war intensify, then Chinese stocks could face renewed selling pressure. This could result in the Chinese stock market falling below its key moving averages, with the moving averages starting to curl down, indicating a change in momentum. On the flip side, if fiscal measures successfully stimulate the economy, the potential upside is substantial. The combination of low valuations, improving profitability, and a more stable economic backdrop could create a powerful tailwind for Chinese equities, leading to higher prices. Let us know in the comment section what you think will happen to the Chinese economy and stock market next. You can trade the Chinese stock market ETF MCHI on Capital.com. Thank you for watching.